Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories behind those big corporate numbers. And let me tell you, this latest report from Avalon GloboCare Corp Albat might just be a thriller. Stick around, because we are diving deep into their financial roller coaster. Before we jump in, if you love getting clear, no. Nonsense insights from inside a company reports like this, make sure you hit that subscribe button. And hey, if you want to chat about these findings and connect with other finance enthusiasts, our Discord community is linked right in the description below. Join us there. Alright, let's get straight into the numbers for Avalon GloboCare. They've just dropped their report for the quarter ending the 30th of September 2025, and it paints a picture that has definitely got me raising an eyebrow. Looking at their balance sheet, a big thing stands out immediately. Their cash balance has shrunk dramatically from about $2.86 million at the end of last year to a little over $333,000 now. That is a huge drop, almost 88%. This is the kind of number that makes you stop and wonder where all the money went. Their total current assets have also taken a hit. They went from over $3.2 million down to about $2.1 million. Part of that is the cash, but they also have new assets like receivable from sale of equity method investment, which has jumped up significantly. This means they are owed a good chunk of money from selling off a piece of another company, which is a good sign. But it doesn't cover the massive cash drain. Now, their current liabilities, the money they owe in the short term, are still quite high. They're over $13.6 million. Noticeably, accrued professional fees have more than doubled from about $600,000 to over $1.3 million. This often signals a company is spending a lot on lawyers and consultants, perhaps for deals or legal battles, which we'll look at later. And here is where it gets really interesting. Their total liabilities are over $13.6 million, but their total equity has gone from a positive $7.1 million to a negative $4.5 million. This means the company's liabilities now outweigh its assets, putting them in a deficit. This is a red flag for financial health and a major concern for investors. Let's see how their operations are performing. They're bringing in some rental income from their properties. For the 3 months ending the 30th of September 2025, they made about $350,000, and for the 9 months, over $1 million. This is steady, but it is their real estate business, and it is not enough to cover all their other expenses. This is where the picture darkens. For the 3 months, their loss from operations was about $76,000, which is better than last year's loss of $1.2 million. But for the 9 months, their operational loss has ballooned to almost $5.8 million, a big jump from about $3.6 million last year. This means their core business operations are losing more money. Now, here is one of the most unusual items, a credit loss recovery of $1.65 million for the 3 months ending the 30th of September 2025. This sounds good, right? But it is a recovery of a loss they had to write off earlier. This happened because they sued Lab Services MSO LLC and later settled, getting some money back. While it looks like a gain, it is really just recovering money they thought was gone forever, and points to a messy situation with that investment. Their other expense net is massive. For the 9 months, it is over $10 million compared to just $1.5 million last year. A big chunk of this is a loss on extinguishment of debt of over $9 million. This usually happens when a company pays off debt in a way that is more expensive than planned, or when they restructure it unfavorably. Putting it all together, their net loss for the 9 months ending the 30th of September 2025 is a staggering $16.2 million. That is triple last year's net loss of about $5.2 million. It is clear the company is bleeding cash. This table really hammers home the financial struggle. At the start of the year, they had a positive equity of over $7 million. By the end of September, their total equity had swung to a deficit of over $4.4 million. This rapid change is a serious warning sign. Let's look at where the cash is actually going. For the 9 months ending the 30th of September 2025, they used almost $4.4 million in cash just to run their day-to-day operations. Last year, it was about $3.9 million. This increase in cash needed for operations is concerning, especially given their shrinking cash reserves. In investing activities, they received about $750,000 in cash from selling off an investment. That is a positive, but it is not enough to offset their operational cash burn. They did bring in over $1.1 million through financing activities. This usually means they sold more stock or borrowed money. Given their financial state, this is likely necessary to keep the lights on, but it is an unsustainable strategy long term. The end result is a total decrease in cash of over $2.5 million for the 9 months. This is a huge burn rate. The company is trying to shift its focus. They are now mainly focused on this key-to-air breathalyzer device and their real estate. They've also been dissolving some of their older, less promising ventures like their lab services and some patent holding companies. This is a smart move to cut losses, but the question is whether the new focus will be profitable enough fast enough. This section is stark. The report explicitly states that there are substantial doubt about the company's ability to continue as a going concern. This means the auditors are seriously questioning if the company can survive the next year. They say the company's survival depends on raising more money and successfully selling their products. But there is no assurance this will happen. This is as close to a financial emergency warning as you can get. Here they talk about how they value things. One big item is derivative liability. This relates to complex financial instruments, likely warrants and convertible notes. The fact that it is a fluctuating liability suggests a lot of financial engineering is happening, which can be risky. It shows up as changes in fair value of financial instruments. And for them, they're carrying a derivative liability of about $100,000. This is where a lot of the financial drama is. They had a convertible note with Mast Hill Fund LP that was a mess of extensions, waivers, and fees. They ended up paying a significant waiver fee and issuing what are called pre-funded warrants, which are like special rights to buy stock later. Then, they had a loss on extinguishment of debt of over $9 million related to this note. This is a massive hit, showing how expensive it was to manage this debt. They also issued a new convertible note that adds to their future obligations. This section details all the different types of preferred stock they have issued. They have Series A, B, C, and D preferred stock. What is concerning is the significant amount of money they've raised through these preferred shares, especially Series D, which is a substantial amount just for this quarter. Each issuance comes with complex terms that can affect common shareholders. For example, Series C and D preferred stock are convertible into common stock at a very low price of $2.41 per S-share, which is much lower than their current stock price might suggest, meaning if they convert, a lot of new shares could flood the market, diluting existing shareholders. This note warns about potential problems. They are involved in a lawsuit that started in 2019 with the Research Institute at Nationwide Children's Hospital concerning trade secrets. They agreed to pay a large settlement, including a percentage of their future profits. While they've paid some of it, there are still profit-sharing obligations. This kind of ongoing legal cost is a significant burden. They also mentioned filing a lawsuit against Laboratory Services MSO LLC. This is the one related to the credit loss recovery we saw earlier. They settled this, getting over $1.7 million promised, but it shows past investment that went sour, leading to legal costs and complexities. This shows they've been selling stock and warrants outside of public markets to raise cash. They sold shares and pre-funded warrants in July for over $450,000. These private sales are a common way for struggling companies to get much-needed cash injections, but they often come with dilutive terms for existing shareholders. There is a leadership change here. The CEO, David Jin, is resigning due to health reasons, and the Kushu Mang Lee is stepping in as interim CEO. Leadership changes, especially unexpected ones, can add further instability to a company already facing serious challenges. Overall, Avalon GloboCare is in a tough spot. They have a serious going concern issue, meaning they might not make it through the next year without massive financial changes. Their cash is running dangerously low, operational losses are mounting, and they've taken on huge debt and complex financial instruments that have resulted in significant losses. The rental income is stable, but insufficient. The credit loss recovery and legal issues show a history of messy investments and disputes. The leadership change adds another layer of uncertainty. Their strategy seems to be pivoting more towards the Kedawai device and real estate, which are simpler businesses, but the speed at which they need to generate revenue from these is critical. The sheer amount of money they spent on professional fees recently, likely related to mergers and financings, is eye-watering and points to a company in constant financial maneuvering rather than solid operational growth. The risks highlighted in their filings, like competition and economic downturns, are amplified by their precarious financial position. They are highly dependent on raising more money, and given the current cash burn and deficit equity, it will be challenging to do so on favourable terms. In conclusion, this 10Q paints a picture of a company fighting for survival, while they have some steady income from real estate and are trying to commercialize new products. The massive operational losses, huge debt-related expenses, and shrinking cash reserves paint a very concerning financial outlook. The going concern warning cannot be ignored. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.